Most of us are conditioned from day one to take our hard-earned money and lock it inside a bank account. We treat that vault like the ultimate finish line because it feels completely secure. But treating your bank as a permanent storage facility guarantees you will lose money. The financial system is mathematically structured to erode stagnant cash over time. While banks take your deposits and earn high returns lending them out, they typically pay you back around 3 to 4%. Meanwhile, the actual cost of goods and services is rising at nearly double that rate. This chart tracks what happens to 100,000 rupees sitting in a standard savings account over 10 years. The lower line is your 3% interest. The steeper line above it is 6 to 7% inflation. That red wedge widening between the lines tracks the specific cumulative loss of your purchasing power over a decade. A savings account effectively protects your cash from a burglar, but the low-yield environment systematically extracts its value year after year. The only mathematical defense against this slow drain is shifting from a pure saver to an asset builder, putting your money and time into systems that appreciate or generate income. But if you go online today, you are hit with an overwhelming wall of options. Everyone says to buy real estate or learn coding, invest in mutual funds, or start an e-commerce store. To sort through the noise, you have to evaluate the required down payment. Every single asset demands an upfront cost of either your sweat equity, meaning your time and intense effort, or your financial capital. We can map these 10 commonly promoted assets onto a single grid. The vertical axis measures the time and effort required, and the horizontal axis measures the hard cash needed to begin. Selecting an asset requires an honest audit of your current status. You need a vehicle that aligns perfectly with the time or capital you have available. Now let's look at the first group. These are vehicles that demand massive amounts of your personal energy, but almost zero upfront cash. This includes developing high-income skills, building digital assets like a YouTube channel, or running an online e-commerce store. Placing these on our framework puts them strictly in the top left quadrant. They require very little financial capital, but maximum time commitment. To make these work, you have to front-load hundreds of hours of unpaid labor. You will face a steep learning curve, zero initial views, and relentless market testing before you see a single dollar. If you survive that friction, the reward is substantial. You create scalable digital leverage that can generate significant, repeating active cash flow, independent of a traditional salary. Despite what online courses claim, there is absolutely nothing passive about these vehicles. They are intense, highly active systems requiring a long period of delayed gratification before they pay out. The second category is built for people who already have a stable primary income and almost no free time. This covers broad market mutual funds via systematic investment plans, real estate investment trusts, bonds, and gold. On the framework, these sit low on the vertical time axis and stretch across the moderate capital range. The entire mechanism relies on discipline rather than daily effort. You set up automated, consistent monthly allocations, completely ignoring the urge to time the market's daily fluctuations. For example, buying retail gold jewelry means paying steep design and making charges that immediately dilute your principal. True wealth preservation relies on digital gold, sovereign bonds, or direct bullion, removing those retail fees entirely. The trade-off here is speed. These vehicles offer reliable inflation protection, but their growth is strictly tied to market averages. Compounding these returns takes decades of quiet patience. They are highly effective at buying back your time and preserving purchasing power, but they will not make you a millionaire by next year. The final group is reserved strictly for those with significant cash reserves and a tolerance for heavy losses. We are talking about purchasing shares in individual companies, acquiring direct business ownership, and deploying venture capital. These belong squarely in the top right quadrant. They demand serious financial capital alongside a substantial amount of active risk management. Venture capital specifically sits at the extreme edge of this chart, representing the maximum threshold of both required cash and probability of failure. Participating directly in these markets requires meticulous research, emotional control during severe volatility, and deep enough financial pockets that a total loss won't compromise your living standards. In exchange for taking on that burden, your potential returns are uncapped. One successful startup or correctly timed stock selection can multiply your initial capital exponentially, though the probability of any single bet going to zero remains incredibly high. These are accelerators for those who already have a strong financial base. You must be comfortable seeing your balance drop into the red in the short term to capture long-term multipliers. Knowing how the assets work is only half the equation. The final step is auditing your own life stage and bank balance right now. This flowchart forces a structural decision based strictly on the resources you actually possess. If you are time-rich but cash-poor, like a student or someone just starting their career, your path branches firmly to the left, straight into the sweat equity assets. You should completely ignore venture capital and individual stocks. You do not have the capital to multiply. Your single objective is investing your abundant free time into acquiring high-income skills. If you are a salaried professional, you are likely time-poor but cash-stable. Your path moves to the right, leading straight to the passive accumulators. Your time is already maxed out by your primary job. Do not drain your remaining energy trying to launch an e-commerce side hustle. Instead, deploy your steady cash flow into automated mutual funds and let the market do the heavy lifting. Trying to adopt all 10 of these assets at once across varying categories guarantees that you will burn out your time and destroy your capital. None of these asset systems function properly without a stable foundation. You first need a consistent, reliable primary income stream. Once that income is flowing, you must build a liquid emergency fund. Do not purchase a single asset until you have cash set aside for immediate, unexpected crises. With those protections in place, you begin deploying your surplus resources relentlessly into the exact asset class that fits your current quadrant. Financial independence depends on your ability to rigorously match the right financial tool to the specific season of your life.